quarterly Market Perspectives webinar. I am Margaret Sargent, Senior Marketing Associate here, and I'm very, very pleased to be joined today by our President and CEO, Dr. Richard Michaud, our CIO, Robert Michaud, and Research Analyst, Vitaly Rabanin. So today's webinar is going to kick things off with Robert providing an overview of our investment process and philosophy, followed by Vitaly reviewing the last quarter's performance in terms of both the market and our portfolios. Then Dick will take things over with a discussion of his market perspectives for this quarter, and always we'll have time for some questions at the end. We also have a very special marketing update for you all, so please do stay on the line until the end of the call. Quick housekeeping note, your lines will be muted for the duration of the call to reduce ambient noise. So if you do have questions, please submit those to us using the chat function. And please feel free to submit those throughout the webinar. We'll address them all at the end, but don't feel like you have to wait till the end to submit them. So without further ado, I will pass things over to Robert.
All right, thank you, Margaret. So as always, I'd like to start with a review of our investment process. This is in part to remind you that our focus is always on consistent portfolio construction with an investment framework well beyond just this one quarter that we're going to be talking about today. So just to give you the picture, this applies to all of our risk-targeted portfolios. What we have is a whole spectrum from 20/80 to full equity risk-targeted portfolios, which are consistently managed for either a total return, an after-tax return, or multi-asset income objective. So what's our philosophy? Well, to start off in this idea is to take the best practices of the institutional asset management world, improve upon them, and first start by avoiding mistakes. And so avoiding a mistake is taking any sort of risk that you are unlikely to be compensated for. And so that has to do with avoid trying to predict the future, stock picking, trying to find outperforming active mutual funds, picking asset classes, or trying to time markets. All of these things have some potential for improving performance, but also potential to reduce it as well. And so by steering clear of these things, you can reduce the risk in your portfolio and tend to not hurt the performance at all. And so then the second part is to try to do things that we do have, think can add value to investors through reliable, repeatable investment practices. So diversification is a big one. We diversify by having ETFs that represent thousands of individual stocks and bonds on a security level, 27 different asset classes across global geographies, risk factors, stocks, bonds, and anything that can be liquidly invested in through ETFs. We try to manage costs through limiting turnover, taxes, but we're not trying to drive costs to zero. We are trying to understand that there is sometimes a benefit to certain asset classes that you need to pay for exposure to. We have a strategic but not static forecasting process. So what we're really trying to do is understand today's market risk and return trade-off without speculating about the future, but by using all currently available data to do the best job that we can. And then we're going to optimize portfolios for specific investment objectives. And this has the dual benefit of maximizing return while minimizing risk, but also building portfolios that are more comfortable for individual investors, be they conservative, aggressive, or have some other objective. So just to go quickly through our process and what the steps are, you can think of it as we occasionally change the ETFs in our portfolio. Our inputs, our capital market assumptions are updated at least every month. Our investment committee meets every week to review the portfolios. And much of what we do is we don't create whole new optimized portfolios and trade them every week. Instead, what we do is we review the output of a rebalance test, which monitors on a daily basis every portfolio that we manage to make sure that every portfolio has the right risk characteristics for its investment objectives on a daily basis. These apply across all three strategies. I just want to point out that The big difference between our portfolios, we don't come up with different capital market assumptions or anything like that, is they're meant for different investment objectives. So be they a conservative or an aggressive total return, for tax-sensitive optimization, we don't just throw out the treasuries and swap in municipal bonds. We re-optimize the whole portfolio for tax-sensitive investors, and the multi-asset income portfolios are designed for an investor whose primary investment objective is, instead of just the volatility, the growth and volatility of the value of the portfolio, it's how much income can the portfolio sustain and how much will that income grow over time. Just want to remind you that we're an independent manager, so we choose what we think are the best ETFs across all providers. The only reason why we choose an ETF is we think it's the best for meeting investment objectives. And so we have, across many risk factors, across different geographies and asset classes, we have ETFs from iShares, Vanguard, State Street, PowerShares, WisdomTree, and others. As far as estimating risk and return, as I said, we just try to keep things up to date. We try to understand the risk and return relationships going on today. And we do that through a combination of historical information, where we use good statistics to separate some of the signal from the noise of the past. We include academic theories, the literature about the value premium, size premium, and so on. And then we also take things that the market is telling us today, like the yield curve, like credit spreads, sometimes like volatilities, to make sure that the inputs to the optimization process are as up-to-date and reliable and relevant to the market as possible. And then we optimize the portfolio. And so I always like to contrast this to what people who don't optimize portfolios do, which is they simply pick a group of stocks, a group of bonds, and then they connect the dots. So for any conservative, moderate, or aggressive portfolio, they're giving you exactly the same sets of stocks and bonds. So the same ratio of large cap stocks to emerging markets for the most conservative and the most aggressive investors. And then you see many companies like Vanguard and DFA who just have some sort of prescribed, very simple relationships that they think are good enough for any investor for any investment objective. Then if you want to build a taxable portfolio, use the same things, but just replace the bonds with tax-exempt bonds or something like that. Clearly, asset managers can do a better job than that. And that's what we try to focus on. And it's a big place where we try to add value and differentiate our portfolios, is by building portfolios that both make better sense for different investor objectives. And as you want to build an aggressive portfolio, you want to be aggressively going after the available return premia out there, not just throwing a lot of stocks at investors, and especially in environments like now where bonds can be risky. You want to be thinking about the total risk of your portfolio, not just naively adding more bonds to it. And then the other thing, of course, that you can do is you can maximize return and minimize risk. This is without speculating. This is without any special information about markets. This is through better portfolio construction. And just a quick proof that we like to show is that conservative and aggressive portfolios, if you look at the bonds, if you look at the stocks, they look very different. If you look at the bonds and stocks in our tax-exempt or multi-asset income portfolio, they all look very different. And they're different because they are built for different investors with different investment objectives, and they should be. So I welcome you to take a deeper dive into our portfolios and see what's inside. So how do we do this? We do this through optimization. Optimization that doesn't focus on a single market scenario, but builds a portfolio that acknowledges that the future can work out in many different ways, and no one has perfect information about the risk, the return, the correlations, and everything else between asset classes. And so what we got our patents for, what we published books for, was early on this research. And it turns out it is a good way of building a well-diversified portfolio that even Markowitz said, in 30 out of 30 tests, that this actually improved performance over any alternative that he could try or was out there he could think of. So, so that's a nice thing for somebody to say. So, so what does it look like? It looks like much more diversified portfolios. They're diversified portfolios that, according to Marcus, don't just look better. Markowitz don't just look better. Sorry, my son's name is Marcus. They're better diversified and they perform better. And this is an example of a statistical simulation which shows that outcomes can be more compressed. You never know the future. You can never perfectly tell you what a portfolio is going to have, but you can get better outcomes. And then the last responsibility of an asset manager is to keep track of portfolios, monitor them, make sure that they have the right characteristics on a very regular basis. We did not want to have a calendar rule where we go on vacation for 11 months and then just build a portfolio once a year. And so we wanted to solve the problem. If you have an optimal portfolio, you can trade to it, that's perfect, but then time passes and your portfolio changes, prices drift away. And then simultaneously, new information is arriving and you're getting new optimal portfolios. And so but you need to know, has enough changed that it's actually going to benefit the investor to trade? And so this is where our statistical rebalance test comes, that gets run every single night, is to help us determine when portfolios need to be traded. So I'm going to end here. Historically, we've traded between 1 to 3 times a year. We have very nicely diversified portfolios, and Vitaly will tell you a little bit about what has happened recently.
Thank you, Robert, for your overview of our investment process. Now I'm going to walk you through global asset performance and New Frontiers performance over the past quarter. In front of you, you see a chart detailing how global asset classes have performed over the last quarter and the year. On the left, in the light blue, you see quarterly performance, and on the right, in somewhat darker blue, you see yearly performance. Couple of quick notes. U.S. large cap is up for both quarter and the year, especially real estate. This is important because U.S. continues to be a main driver and consistently performing asset class for the last at least year. Important to note that value and growth split continues to persist. Growth outperforms value in the domestic market, and similarly, more aggressive growth-oriented small cap once again is also performing than value securities. Emerging markets for this quarter and basically the year justify a nickname of submerging markets. They have, to put it lightly, tanked. They have been the worst asset class over the last quarter and the year by far. Another interesting fact I want to point out is, as you can see, global equities, excluding United States, are down for both quarter and the year, while Europe is up for the quarter and Japan is up for the quarter. How can that happen? Well, the answer lies in currencies. European and Japanese indices that are displayed in this chart are local currency denominated. So in case of Europe, it's euro. In case of Japan, it's yen. While global equity ex-US is a US dollar denominated fund, which explains how this performance reconciles. The major takeaway from this is that dollar is up, and that plays a large role when you're evaluating performance of foreign funds. And some of that played a role in emerging market performance as well. Now let's take a look at New Frontier performance. Leftmost two bars show quarterly and yearly performance of a New Frontier portfolio, and rightmost two bars show the respective benchmark. Right now you see standard portfolio performance, and generally it's mixed across a given time frame and profiles. More aggressive portfolios such as 90-10 and 100-0 did better on a year-to-date basis, and other profiles were more affected by the challenging fixed income market, which I'm going to go into more details later in this presentation. Tax-sensitive performance is slightly different compared to standard portfolios. Quarter-to-date is slightly better. Year-to-date is still good for profiles of 4, 5, and 6. Most of the difference is attributed to municipal bonds performance, and once again, I'm going to come back to fixed income and how it affected our portfolios later in this presentation. Here are our MAI portfolios, and basically relatively to a benchmark, it's an overall good performance on both yearly and quarterly basis for these portfolios, but it is still a challenging time for income-oriented portfolios. As I have mentioned before, value growth split continues to persist in the domestic market, and since dividend stocks are mostly value stocks, it definitely has an impact on the portfolio performance. Now let's take a look at the fixed income and what mattered over the last year. On the chart, you see fixed income performance across different fixed income asset classes over year to date in 2018. So in white, you have an iShares short bond fund. In dashed orange, loan treasuries. In dashed yellow, you see munis. In solid red, it's loan corporates. In dashed yellow, you see short high yield. And in dashed red, it's emergent bonds. So a couple of important points to mention. Duration is up for the quarter, but still down for the year. Since we consider duration to be an important fixed income premium, this definitely has an impact on our performance. Sometimes being slightly overweight in duration most of the time being slightly overweight in duration helps, other times it subtracts. Emergent bonds performance was consistent with the rest of the emerging markets. It was just as bad. Once again, dollar played a very large role, large portion of that. It strengthened considerably over the last 3-4 months. This so far has been a very bad year for the corporate bonds. It is important because corporate bonds remain a large portion of the fixed income portfolio, pretty much universally across all asset managers. And municipal bonds are doing quite well relative to other fixed income securities. Also, high yield, surprisingly enough, does relatively well, especially considered to more diversified fixed income benchmarks. It's quite hard to explain this phenomenon behind corporates underperforming, high yield performing well. There are multiple theories of why that happens, but there is no consensus opinion. Let's take a look at one possible explanation what motivates some of this fixed income performance. Yield curve has flattened considerably over time, and that has been a major news topic. However, there are multiple different yield curves. What you see right now are two yield curves at two different points in time. One of them shows yields for corporate bonds, second one for treasuries. One is for the end of Q2 of 2018 and the other one of Q2 2017. Important takeaway from this is as follows. It is treasuries yield curve that has flattened, but corporate yield curve is still nicely concave. So there is still some of the duration premium there, and investors expect to be compensated for assuming some of the duration risk in the corporate bond market. How it's going to develop in the future remains unknown, and with that, I'm going to pass it on to Dick, who is going to talk about his global market perspectives.
Okay, well, thank you very much, Vitaly, for that nice presentation. I am going to talk about the market perspectives for the firm and tariffs and the end of stimulus. I'm going to be touching on market volatility, central bank policies. Tariff policies are very much in the news. Singapore meeting the end of synchronized global growth, rising rates, tariff war implications, and some issues on Social Security. Despite dramatic international and domestic political controversies, the domestic equity volatility remains at or below historical norms, levels that have largely persisted for years, almost throughout for the last 10 years practically, interrupted only by the previous quarter. U.S. equities continued to underperform, a story very much associated with the central bank policies. So the U.S. economy is in great shape, is what every economist seems to be telling us. The Fed, as a consequence, raised rates in June and signaled to likely more this year. The economy has strengthened dramatically since the terrible days of the 2008 downturn. The Fed's benchmark rate is now at 2%. Unemployment is very nice, targeted 4%. The Atlanta Fed has forecast that the growth rate for the quarter will be an astonishing 4.8% growth rate. So we are approaching a normal economic functioning level for the U.S. economy. Yet high yield bonds, as Vitaly was just pointing out, have been benefiting from a very strong economy. One of the reasons, of course, is that they're not affected by emerging markets and Europe. And another way of thinking about what's going on here, though, is the federal tax cut implications are not trivial. There is a tax revenue decline, and the government is increasing spending. Interest on federal debt is now 7.5%, and in 10 years, 12%. So this is all part of what we need to be thinking about as we look down the future, down the road. The European economy, on the other hand, is something very different. It has, and in spite of the sluggish European economic growth, the European Central Bank has decided to end stimulus policies. They will cease bond buying policy at the end of the year. So clearly, the considerations have to do with beyond pure economics. The European zone, the Eurozone, is presumed to be able, aspirationally at least, to manage growth without stimulus. I think many still believe that to be true. The bank, the EC Bank, is unwilling to save politicians from themselves. There are a number of issues associated with the Eurozone economies and countries. It wants to remain in economic sync with the U.S. I think that's very important for the ECB to manage what it is that it needs to do. But this policy is full of risks. Italy has been taken over by anti-Euro populist politicians. So an anti-Euro Italy is a pretty serious issue here. The Trump tariff policies have created lots of disruptions in trade relationships, and who knows where that's going to go. Deutsche Bank is the most serious and most important bank in Germany, is in crisis. And Mario Draghi's term as ECB president is ending in October, and that really does reflect a fairly serious problem. On the other hand, we have unilateralist trade policies that are affecting global economies here. The president has long complained, and he really has for quite a long time, foreign governments taking advantage of U.S.'s low tariff policy. We probably have the lowest tariff policy of any major economy in the world. U.S. free trade policies, according to the president, has hollowed out many U.S. industries. The global world trade order is unbalanced, and we cooperate. Nobody else cooperates. We are disadvantaged. So, Europe. According to the president, America pays for most military infrastructure. 67% is some objective measures, keeping Europe safe and prosperous. But the Europeans, on the other hand, spend much less, according to on their own defense, building vast welfare systems, free universities, free healthcare, have a large trade imbalance with America, have well-protected export industries, and they penalize American companies when they try to trade in the free trade zone in the Eurozone. China is even more egregious in terms of these issues here. The U.S. has agreed at one time to allow China to be a member of the World Trade Organization. The rationalization in the previous administrations was to rationalize, to enrich the Chinese middle class and to bring them to a democratic kind of government. The president claims, and he has much to say that supports his claims, that the opposite has happened. China grows wealthy stealing intellectual property. It rejects reciprocity in investment and trade relations. It requires foreign businesses to participate in no-control ventures. Foreign approval it depends on technology transfers. Otherwise, you don't get approved. It's an unchecked abuse of global free trade, World Trade Organization principles. So President Trump readily insists on a fair deal with trading partners, and he's apparently willing to insist on imposing draconian tariffs if he does not get his word right. The problem here is that, in some sense, nobody wins. Okay, it's called the prisoner's dilemma. All agents defecting leads to a suboptimal equilibrium for everybody. Trade wars change the global economic and political dynamic, and it reduces global economic value. And we want to keep in mind that historically wars have been fought over trade policies. We've had some pretty good news, or at least seemingly good news. The Trump-Kim Jong Singapore meeting, Kim pledging to denuclearize the Korean Peninsula. This is potentially at least a historical, truly historical geopolitical accomplishment by the administration. We've also seen two Korean leaders propose having détente between the two Koreas on the peninsula. Unfortunately, as we all have learned, there are many questions of what Kim promised and when. And there's no timetable for the inspections. There's the effort to reach out to North Korea is very, very good news for the world, but a non-compliance could turn from euphoria to a bitter conflict. It's a pretty serious issue here. There are domestic political risks that we can't really ignore as we think about investing. There's a 2-year investigation that just charged the Trump Foundation for fraud. The zero tolerance immigration policy, which is a complete PR disaster for the administration, widely condemned and rescinded at this point. We have a number of investigations, the Cohen, the Stormy Daniels, the Mueller investigation, and Paul Manafort, the Trump campaign manager, is currently in jail for tampering witnesses. So the president has never been a stranger to lawsuits in his business dealings historically, but we have many legal issues for a sitting president and many risks to domestic politics. Let's look ahead. Synchronized global growth has ended. It was wonderful at the time. All of the economies were growing pretty much in the same kind of lockstep way. It's gone. U.S. is strengthening as Europe and the others are sluggish. The U.S. economic growth is accelerating, and forecasts of normal economic U.S. policy is by next year. So by next year, we might really be totally out of the woods as far as the Great Recession is concerned. Europe, on the other hand, had been expected to lead global growth, but there are lots of issues going on in the Eurozone and in the European Union. France has had labor strikes. There's the anti-Euro Italy. There's Spain. There's political turmoil in the Eurozone, European Union as well, and there's such softer economic data. And of course, there's China. China is also experiencing slowing growth. So capital markets are definitely in the crosshairs of trade policies, and that is not going to help. Okay. Something to say about China. Okay. Despite China's strong and sustained economic expansion, it is very vulnerable to tariff and investment restrictions, and it's because its growth has been underwritten by an even faster increase in debt. The Shanghai Composite hit bid territory this quarter. Yuan is in a 6-month low in the quarter. There's been some effort to reduce the hawkishness of the Trump tariff policies, but even today there are ongoing proposals for more Chinese tariffs, up to $200 billion of tariffs. $200 billion. The Fed's rising rate policy is also something to be being aware of. Okay, certainly it's diminished attractiveness for the defensive stocks, the dividend yield stocks, the REITs, the telecoms, the consumer staples. A treasury yield of 3% makes the real estate stocks in the S&P not particularly competitive, and they have seen lots of redemptions. It's an important issue. And then, of course, what Vinali was talking about is that there's been a negative impact on emerging markets that are tied to the dollar, and many of them are tied to the dollar. By any measure, and it's almost funny, by any measure, a serious trade war should matter a great deal to investors. But the market is largely undisturbed. A positive theory of why the market continues to ignore all of this has to do with the fact that here are some pretty important reasons. The health of the U.S. economy trumps any geopolitical concerns. Corporate earnings have been robust. The U.S. can win a trade war with anyone, with any economy in the world. Unemployment is at multi-year lows. Retail sales are strong. Consumer confidence is high. Inflation is subdued. Tax cuts promote higher spending. What's there not to like? There's almost everything going on right now as far as the U.S. economy is concerned, and the trade wars shouldn't matter for many, many people who are thinking about the problem. Wall Street's not forecasting any hits to the economy because of the trading war policies. But something always to keep in mind is there's other things going on that we may want to consider. The S&P remains below its January peak. So why is that happening? We've had tax stimulus policies here. The market seems to be ignoring any benefits of the tax stimulus policies. Something to think about. We also have increased borrowing required to cover tax cut fiscal shortfalls with rising rates. So that's something else to think about. And tariffs increase costs of business, no question about it, and limit profits for many kinds of businesses. What happens when tariff countries retaliate, if they really get involved in doing so? It can't but help limit global economic growth. And so some of what may be happening here is kind of hard to know, but investors may be wondering about whether there's a calm before the storm. And there are rising political tensions that are among the top investor concerns currently here, because these new tariff policies do fundamentally sour geopolitical relationships. The global political climate can be turning toxic. It's unclear, but there's an awful lot of concern about the political climate globally. America is now seen as an unreliable friend by many one-time friends. The mutual defense treaties seem to be much less reliable than they used to be. It could be a backlash of bitter friends. We may not see the same European leaders that we see right now based on all of this stuff that's going on. So there are many long-term risks. I want to talk once more, finally here, to a subject that is important to almost everybody on this call: Social Security and the immigration conundrum. Congress has been warned that the funds are running out of money. Revenue from payroll taxes are lower than they have been predicted. Spending for benefits and Medicare are much higher than they have been predicted. Spending exceeds revenue, and spending of principal has begun. That is a serious point. That is a very serious issue for any kind of pay-as-you-go system. And it's not just the federal government. The states have been impacted by retirement costs as well. They've had to reduce spending on health care and education. And boy, do they have a liability funding deficit. America is getting older. Active workforce is shrinking. And baby boomers are driving non-working older adults, and it's a challenge to retirement and medical programs. In 1980, there were 19 adults 65 and older for every 100 working. That has been stable for 30 years, but the ratio has been increasing now. There are now 25 adults 65 and older for every 100 working. And it's going to rise, according to projections, to 35 and then 42 by 2040. And other countries also have higher ratios. There's also a low population growth problem. There's been a decline in birth rates since the recession. Without an expanding labor supply, it's awfully hard to achieve economic growth. That's a big problem for Japan and many other countries. So this country is more reliant on immigrants than many people realize. The immigration accounts for more than half of U.S. population growth. Current labor shortage for job openings: 27% of practicing doctors in the United States are foreign born. That's pretty amazing. And without working age immigrants expanding, the trust funds are going to go broke faster than they are now. So robots can only do so much. Service sectors employs far most workers. Doctors and teachers can't be replaced by a robot, right? So my final slide today has to do with this. Social Security funding limitations are becoming urgent, short, and even more so long-term. Immigration reform is a tough sell right now. There's an unreceptive Congress and administration. The focus has largely politically has been on limiting rather than expanding immigration labor. But what are the consequences for long-term economic growth and competitiveness? I leave you an important point. Be careful of what you wish for. Thank you for your time.
Great, thanks, Dick. So I think now we have some time for Q&A. As a reminder, we do have a very exciting marketing update coming up, but we're going to jump into Q&A first. So just as a quick reminder, your lines are muted, so if you have questions, please submit those using the chat function. And so I think the first question is with regards to China. So given the discussion that you provided, Dick, of trade inequalities with China and potential reset via Trump's trade policies, as well as what you called, sluggish growth recently. How is that affecting how we think about continued exposure to the Chinese market in our portfolios?
Well, we're being very, very careful. I think I have the chief investment officer here for the company, and he might be just as well able to answer that question, but it is one of the issues that the investment committee pays a great deal of attention to.
Sure. China has never been a part of our portfolios because of a speculative bet on China. It was in there, originally put in there, as a result of a statistical study that says, does it improve the risk-adjusted return of portfolios across the efficient frontier? And we found that unlike many other economies, such as India, Brazil, Russia, and others, that it really was a significant and meaningfully different market that needed to be treated separately. And since then, China has only become more important as part of the global economy, and it has not fully integrated in with the rest of the economy either. So it continues to be something that has its own risk characteristics, its own way of moving its own markets, and it's an important part of a diversified portfolio. I mean, the other piece is that there, according to some economists, should be a conceptual relationship between the size of the economy, the potential growth of the economy, and its role in a portfolio.
The China ETF that we invest in has done quite well on a yearly basis, one-year basis, for example. But the recent performance for China, and especially with respect to what's going on geopolitically, are all issues that we pay a great deal of attention to, and part of our weekly meetings at the Investment Policy Committee. So we're going to keep a close eye on this, but it's unclear, as I pointed out as part of that slide, is that there's an effort by the Congress, especially the Republican version of the Congress, to mediate the investment issues associated with investing in American companies, and therefore just appropriating American technology. There's a work going on to try to resolve some of these issues, but on the other hand, as you know, just today it was announced that another $200 billion of goods will be tariffed. That will only happen in October, as you know. But on the other hand, it is something that it may or may not be mediated away. It certainly is something that the president may want to negotiate with and get something for what it is he is feeling uncomfortable about what we have not been getting.
Great. Thanks, guys. So this question, switching gears a little bit. So how likely do you think it is that the yield curve will flatten further and invert? And do you agree that that would forecast a recession?
No, we don't agree that it will forecast a recession because the American economy is so strong currently. So it would be surprising if that is the case. On the other hand, it does have an effect on many kinds of issues associated with duration, credit risk, and maturities, and so on. So as we were talking about, as Vitaly was talking about, high yield securities, certain kinds of duration effects do happen at the longer term, longer maturity corporate bonds and so on. So we're paying a lot of attention to all of this. Inverting, it seems unlikely in my mind. It's never impossible. But the American economy is so strong that it would be hard to believe that we dip into a recession because of an inverted yield curve. It does, however, have a fairly large effect on many of the assets that we are investing in today.
I would say some of that is up to the Fed, right? The Fed's been pushing up the short end of the yield curve, but the longer end is determined by supply and demand in the market. And so the Fed could easily invert the yield curve if it so choose, but why would it want to do that? So at some point it should consider, well, the market isn't saying that intermediate and longer term interest rates should be that much higher. So it might want to consider slowing raising interest rates on the shorter end of the curve. The basic idea behind why it's not good to see an inverted yield curve is kind of twofold. From the business side, for financial markets, the way that banks historically have made money is by taking deposits and paying short-term rates and then investing them and lending them at longer-term rates. And so a increasing yield curve leads to a healthier functioning of that part of the financial market. The other thing is more of a macroeconomic argument, which is if there is low long-term interest rates, that means that no one wants to borrow and invest long-term, which means that people's expectations about the future are not terribly optimistic. And I think that's the main basis for this idea behind inverted yield curves are a harbinger of doom. So, but it doesn't have to be that way. The yield curve can do its own thing for a variety of reasons.
And the other reason, Robert, is that we're pretty much at a natural rate or a normal rate for the functioning of the economy right now. There might be some more increases in interest rates, but there's not much left to do, I think. Yeah.
Great, thank you guys. So I think that's all the questions that we have time to get to. If you do have any questions that weren't covered during the call, please feel free to reach out to us after, and we would be happy to talk to you. You have all of these friendly faces to support you from the New Frontier team, so I'm sure many of you have already worked directly with David Schubach. He is boots on the ground. He will meet with you in your office. He has traveled with many of you. And Nick Lamb and myself are here at the New Frontier office to support you, answer any questions, provide any materials. So please do not hesitate to reach out to any of us if you need anything. And as always, we encourage you guys to take advantage of our advisor portal, Frontier Advisor, where we have been sharing marketing materials, blog posts, portfolio analytics, and more in a space that's designed to really be a one-stop resource center for you as the advisor. And we are very excited to announce that we will be launching our own internal proposal system on Frontier Advisor. We are right on the cusp of releasing this to all of you, so please keep an eye out for our email announcement. And we really designed this to be a simple interface that gives you a chance to run proposals on New Frontier portfolios for your client. So it is a simple 3-screen process. You will put in your information. You'll have the option to add in your own firm description and logo. You will put in your client information and select the appropriate portfolio given your client's risk tolerance. And finally, you'll have the option to put in your own fees. This will auto-populate based on your current platform, and you'll have the option to adjust any of them to reflect your current situation with your client. And all of this will go into the system to generate our new investment proposal packet. And I would love to just walk you guys through quickly what that packet is going to look like. If our keyboard works. So this is going to give you a really nice combination of both specifics about your client's portfolio as well as information on New Frontier investment process and philosophy. So the kinds of things that we cover in our intro webinars that many of you have attended, a lot of that information will be covered also in this proposal packet. So you'll see that all of the information that you put in terms of your fee structure will be reflected on the portfolio performance page. So this will show you, given your risk level, given your platform, what the performance for your client's portfolio is going to look like. And then in addition to all of this portfolio specific information, we will also cover a lot of materials that I'm sure you guys are familiar with seeing, things like how we invest, things that you might see in both our presentations and things like the pitch book, where you'll see a walkthrough of our process. And I know, many of you have been looking for important resources for educating your clients on New Frontier, both our products and our process and philosophy. And so we're thrilled to be able to provide this to all of you as an arrow in your quiver for doing just that. So we are right on the cusp, as I said, of being ready to launch this this proposal system. So we'll be sending out an email announcement to all of you. So please keep an eye out for that. And if you have any questions or you would like to see more of the system directly, please reach out to myself or to Nick. We are happy to provide an overview of how it will work and walk you through the process. And I think that just about does it for us for today. So I think that's everything.
Can we just point out to them that this page will be dynamically illustrated depending on what they will plug into fees.
Exactly.
Okay. And so this will be really, truly an innovation that I think nobody else has in the investment community currently. If you go back to the previous page, not that one, obviously. The page with the inputs of the fees or something like that. Okay.
Sorry, bear with us for a second.
Yeah. Okay. I think this proposal system will make be so much easier for you to use, so much easier for you to interact with your clients. You'll be able to plug in the fee associated with our strategies, the platform you prefer. You would like to use the custody fee associated with that platform. Of course, it has to do with the asset management level, the assets level, and of course your fee. And then you can submit it, and then the next page will show the performance associated with those fees. I think dynamically it's pretty amazing and a real innovation for the advisor community.
Great, thanks, Dick. See, this is why Dick is the head of the marketing committee. But yeah, we are very, very excited to share this with you. So please do keep an eye out for our email. And I think that wraps up everything we have for you guys today. So thank you so much for joining us, and we will see you next quarter.